the latest on the economy, and questions you may have about Social Security. All that and more today on Your Wealth Health. Welcome again to another episode of Your Wealth Health. I'm Eric Brenner, president and founder of Hilltop Wealth Solutions, and I'm glad you joined me here today. We've got a full topic of agendas today. If you're watching us on Fox Michiana this morning, thank you for doing that, and we really appreciate all the support and all of those of you that are watching us each week. You may be watching us on Facebook, and if you are, please share us, and you may be watching us on yourwealthhealth.com. Well, the economy continues to struggle as we continue in this global pandemic, and we're going to dive into the economy in just a little bit. You know, we've got some good news. The recovery plan, the CARES Act came out a few weeks ago. Small businesses now are starting to get some of their loans, although I know there are a lot of small businesses that are still looking for their money as well as in need of money. We've had the stock market have a couple weeks of run, which has been pretty amazing. And those of us in the business are somewhat perplexed as to really why the stock market is acting the way it is. As well as people should be getting some of their checks. If you haven't got it already, your checks that were coming from the government. As well as the unemployment now. They increased the amount that someone can receive for unemployment, as well as they've extended unemployment in the length of unemployment. So all of those are positives. The challenges are that companies, obviously small businesses and large companies, are struggling. About 6% of small businesses have applied for the payroll protection money that is available. The downside is that means about 94% of small businesses have not applied. And so there's still a big need, and we believe there's still a lot of funding to be done there to help those small businesses. The airlines are struggling. They have reached an agreement with the government to help extend some of their benefits through the fall, but they are certainly going to struggle. As well as oil prices. Oil prices continue to be at all-time lows, and they continue to struggle as well. So today we're practicing social distancing, and we continue to do so until they tell us that it's safe. I'm in the studio here, and I have Bill Davis and Matt Arends, they're private wealth advisors with the firm, and they're joining me via Zoom from their homes. And so let's start off with the economy and the numbers and kind of what's happened over the last week to two. We're in earnings season right now. And so, Bill, what concerns you the most about the most recent economic numbers?
Yeah, thanks, Eric. As we all know, with social distancing, they're the biggest issues, as we'll show on a graphic, in the U.S. economic troubles is retail sales. I mean, nobody can go out and buy anything, and unless they're purchasing online, the retail sales numbers are just going to be atrocious for a while until they figure out how we're going to get back to normal. The banks reported huge losses in the last week, and so they're struggling. And the unemployment numbers are now to unprecedented numbers, over 20 billion people that are unemployed, 20 million people that are unemployed. And so, in the state of Indiana, you brought up it's actually called the Pandemic Unemployment Insurance, PUA. And unfortunately, the state of Indiana has yet to figure out how to implement the federal mandates for that program. So some of our viewers may be frustrated with not only getting to the unemployment resources, but are wondering when this additional $600, if they qualify for up to that much, is going to come into play. And as of this morning, the Department of Workforce Development site says that they are diligently working on that. So, with airlines, travel, leisure, I mean, all of those things are going to be in a mess for quite a long time to come.
Yeah, thanks, Bill. And Matt, we really are perplexed a bit with how the markets have reacted. I know at one point in March, when this all started, the stock market was down, 35% plus, and now it's come back to a year-to-date number of 10, 11% down, 12% down. But we're somewhat perplexed as to the stock market in general, aren't we?
Yeah, you're right. We are. What seems to be interesting is a lot of the market right now is moving on momentum and optimism, which, all things aside, is a good thing when economies and are open and things are pretty calm and normal. But when there's not really any good economic data coming out, aside from government stimulus and government support, it really begs the question of what continues to prop up this market. And right now, we do believe that, there probably was a little oversell in the market. And so some of that has come back. But I think a lot of it just has to do with optimism and hope, momentum that things are going to continue to get back to normal sometime soon. But yet we have not seen the earnings results right now to support what that market growth looks like, outside from government intervention week to week.
Yeah, and Bill, we really think that volatility is not over.
That's correct, Eric. We expect to test the lows. I mean, not all the way down to the 18,000 Dow, but I think we'll certainly test 20,000 on the Dow, and that could be some opportunity buying there. But we really, as we've said over the last couple of weeks, is we want to see about 3 weeks of a reasonable trading range before we're looking to put some opportunity money to work.
And what do we think, Bill, as it relates to what's needed to continue to help really just keep the economy just afloat from maybe the Fed and as well as Congress?
Well, certainly at the time of this taping, we don't know what the Congress actions are going to be, but my expectation is they're going to get a deal during this week. And so hopefully by the time of the viewing of this show, we're going to have that coming into the markets. The Federal Reserve is going to continue to put stimulus money in to the bond markets where necessary. I don't see any issues with that side of the equation.
So as we think about it, and Matt, maybe you can comment on just it's getting, I know, a little bit challenging, more challenging for people just to kind of hang in there and hopefully they're not financially devastated and just hang in there from an investment point of view.
Without a doubt. I think, you kind of have twofold. Is you have some people just saying, hey, there is no stability. What do I do? And you have other people saying, every time the market goes up a bit, did I miss the bottom? Did I miss the opportunity to buy? And again, I think the reality is timing is just super difficult to do. And so if you're looking at long-term investments, there's not really a huge advantage to trying to time the market. I mean, in the short term, it definitely helps. But again, if you miss, and we've shown graphics before, if you miss those up trading days, it's a significant impact. So you might as well just get your money invested and hope for the best. And right now, you just even have other headwinds with oil hitting 21-year lows this week. And so that is something that we haven't even unwrapped yet in the market. It hasn't digested, but it's going to be interesting to see how that influences market growth aside from every other problem going on in the economic activity.
Yep. Well, thanks, Matt. Thanks, Bill. So what if you're close to retirement or we're close to retirement and you're short on cash? We're going to talk about maybe Social Security options, some other options to get out money. So when we return, we'll talk about Social Security and other options to help get you through this pandemic.
One of the nice parts with dealing with instant auto finance is Our cars go through an inspection process. Not every car makes it to the lot. We reject cars because it's just not going to be a good car for our customer. We believe that. So we're not afraid to say no to a car, because we want to say yes to all of our customers. So the cars we have are higher quality than a lot of our competitors are.
Welcome back to Your Wealth Health. So we're practicing social distancing today, and I have Bill Davis and Matt Arenz, which are coming in from their homes. And we're talking about Social Security, and maybe what you have found yourself recently is that you've lost your job, you're in need of cash, you're close to retirement, and you're thinking, maybe I should just draw Social Security to kind of help my cash flow. And so we wanted to help walk through some considerations with you. And so I'll bring Matt back in. And Matt, what should people consider when they think about applying for Social Security?
That's a great question, Eric. I'd love this graphic. If we can throw this graphic up, it just kind of factors to consider. It reminds me of Scarecrow and the Wizard of Oz, just questioning where to go in life. And, you got health status, you've got life expectancy, survivor needs, if you're married or have kids, need for income, whether to work, if you're going to work part-time, that type of thing. All these questions, they all intertwine with each other. And you really have to sit back and look at what are my long-term goals and objectives. And if you don't have values around those and you don't have actual numbers, if it's just a hypothetical question, it's really difficult for us to hone in to help you make that decision. But if you begin to solidify what are those goals, objectives, and put values around them, you can run pretty quick analysis to determine, does it make sense to take my Social Security now? Does it make sense to delay? And we can help you with the reduction or potential growth in what your expected Social Security is at full retirement age.
Yeah, it's a good point. And I think about don't make decisions based on emotion. Someone may have resources, maybe money and cash reserves or other resources that can help them get through this. And you just don't want to make a short-term decision, as you said, that's going to affect you for a long time. So, Bill, we just wanted to kind of ground everybody. If their full retirement age is 67, which is what we call fully funded, as fully funded Social Security, then what really, if they draw early, what are the stakes there? What's the reduction? So why don't we just talk about that for a second?
Yeah, and I think we have a graphic on this as well that shows you that if you go at 62 and you're going to take you're only going to get 70% of your full retirement age benefit for the rest of your life. And so there are other options that we might want to consider, because that's an irrevocable decision that you can't go back on. So you might be 63 and you're still going to take a 75% reduction, or 64, you're at an 80% reduction. And so, I think those are the three really critical ages that people are having difficulty making a decision at, because once they get to 65, sometimes they see a change because they go on Medicare, and maybe they don't need the cash flow to get them through this difficult time. But the fact that it is an irrevocable decision that you'll never be able to change, we should be looking at especially spousal benefit options that we could consider a little early. Or what I think we're going to talk a little bit about here today is use of some other retirement assets other than making this one-time irrevocable decision to take your Social Security early. If you really have to do it, some people might not have any other option. We understand that, but it's one that really requires some serious consideration.
Yeah, Bill, and I think you make a really good point about that irrevocable part. If you think of somebody who has a pension plan through work, that's an irrevocable decision. And so now you wouldn't take a reduction traditionally in your pension plan at work, because you realize, I get one choice at this. I'm going to maximize every dollar that I can receive. And yet with Social Security, oftentimes people will take it early, not really thinking too much about what that impact is going to be or what that reduction is going to be. But it's, if you take it at 62, at 70%, a 30% reduction is really significant, especially when you look at the compounding factor over what could be 20, 30 years. It's a lot of money to give up to try to figure out how to make a short-term gap in what could otherwise be, again, just a short-term financial issue that you don't have to turn into a big problem long-term.
Yeah, it's a good point, Matt. And so I'd like to take a look at this graphic and just put the concept or our discussion to numbers. And as you see on the screen there, we're assuming a primary insured amount, which would be a full retirement age amount of $2,600 at age 67. If somebody claims that at age 62, that's $1,800 is what they would receive. So that's from $2,600 down to $1,800. And you can see that if we look at cumulative benefits, which means if we look at an average life expectancy over the period of time, someone claiming from age 62 compared to them claiming at their full retirement age of 67, the difference is there's a lot of money difference. It's more than $135,000, $140,000 of difference over one's lifetime. If we put a cost of living adjustment, which we have done in this illustration of 2.6%, and we use an average, so the Social Security trustees publish a cost of living adjustment every year, a low, medium, and high, and we use an average number typically in the middle, which is 2.6. Certainly this year, or maybe even next year, or the next couple of years, we may not see much of a cost of living adjustment. But still, we think over time we'll see some sort of cost of living adjustment. And by the way, that cost of living adjustment is not determined by an act of Congress. It's set based on an index. So it depends on what the index did as to what someone would get with their cost of living. So it really can equal a lot of money over time. And it's not just a decision for yourself, Bill. It's a decision for your spouse as well.
Yeah, that's a big deal. And I every time we go over this topic, I think what people understand the least is the compounding effect of that cost of living adjustment. What I talked about in the prior graphic was taking a reduced amount, but in this case, we're talking about looking at the future benefits and taking into account the cost of living adjustments. So, I mean, it's a big number, and so that needs to be considered in somebody's decision to go early or not.
We talked earlier, I think Bill mentioned it, about the other resources. Certainly your tax situation may be different this year. So taking it from another resource may not have as much of a tax impact. And so it's really looking at it what we call holistically, don't you think, Matt?
Without a doubt, it's definitely a holistic decision. You have to view what is this impact going to do for, again, things like health insurance, tax solutions, and planning. You also have to think about, do I have enough resources even saved for a retirement? Sometimes people just don't save enough and they retire, or they're forced into a retirement decision. Certainly something like the current economic situation could force somebody into retirement because they get laid off and they're not the first person to come back, and they just say, I'm 63, might as well retire, and they retire and they don't have enough resources saved up, and they have to make this decision. And so we don't want to make anybody feel shamed or guilty about that decision, but the reality is you do have to look at, should I withdraw from retirement assets in a 401k or an IRA for a year or two, rather than deferring, or rather than taking Social Security early. And a lot of times the way the math works out, it makes sense, but again, you have to look at everybody's situation on an individual standpoint, but you have to do it holistically for that individual.
Yep. Well, thanks, Matt. So we have put together some resources for each of you out there that you can follow and continue to get updated information. If you go to hilltopwealthsolutions.com, we have a market volatility resource center. We continually update that with information, some good information, as well as we have a weekly webinar that you can sign up for on our website. It is Fridays, 3 o'clock Eastern. We continue to get more and more folks coming to that, I know, looking for information, and so you're welcome to sign up for that. And the last thing is we offer a introductory call or video conference. It's free. It's typically 30 minutes just to find out about your situation, and we'll see if we can help guide you along the way. When we return on Your Wealth Health, we're going to talk about some other resources that you may have that you could utilize during these challenging economic times. Welcome back to Your Wealth Health. I'm Eric Brenner. Thanks for joining me today. And we are continuing to practice social distancing. I have Bill Davis and Matt Arends broadcasting from their homes. And in our last segment, we talked about if you need cash, maybe close to Social Security, should you draw Social Security or not? But there are some other ways to get some money to you to help get you through this very challenging time. And Bill, specifically, you had a client recently that took out some money. And so I think you wanted to share with our audience what that was, and maybe we can learn from it.
Yeah, the client was actually retiring from a state retirement plan and thought that it would be good to get some extra cash out of the plan. The participants under the age of 59 and a half, so therefore would be subject to 10% penalty in addition to the tax that he would pay this year. And even people at the state, I think, underestimated the tax payments that he should take out of that amount, and we're confusing a coronavirus effect. So I mean, if there are some rules that allows you to take some 401k, increase the amount of 401k loans you could take, did allow us some IRA rules to allow us to get some IRA money out without the 59.5% penalty. But again, it's all related to, did you have a coronavirus effect that impacted the income for your household? And in this individual's case, he didn't. He had already retired from the state, and now is probably going to have a pretty good size tax bill come next April. And so we want people to be very cautious. In this case, even people at the state were giving bad information. So, consult with a professional, your tax professional, your financial professional, because you could be looking at home equity lines. We could be looking at IRA loans that we could pay back in 60 days, or taking advantage of some of the other things that are in the CARE Act. Maybe Matt, you have some additional thoughts on that.
I do. I think you make a great point. Misinformation can be very costly. I think for us, one of the challenging or sometimes even frustrating parts is when people are making financial decisions that can be a costly decision without fully understanding the new laws that are in place for this particular pandemic. Additionally, just not even talking through that process with an advisor. And so, they're making decisions based on the knowledge that they have or what feels right. And in this particular situation, just didn't get the right information. And that's a costly mistake for that person. The person who gave the misinformation, they're not going to experience that tax bill. And that's a tough pill to swallow. But, when you look at IRAs, again, to your point, Bill, if you're in a situation where you have to pull money out of a retirement plan before 59 and a half, they will waive that 10% excise tax, as long as it's a coronavirus related thing. So a spouse is out of work, unemployment, having to pay bills because you have loss of income due to the pandemic, that type of thing. This isn't just I can take money out as I feel and and spend it on a new car. That's not really what this is for. This is for pandemic related activities. And so those types of things we got to really pay attention to. Even borrowing in your 401k, those limits have increased and the percentage of the balances have increased. Even on the IRA distribution, having to pay the tax bill for that, they're allowing you to extend that over 3 years. So there's a lot of different loopholes and caveats to that plan. You just have to have proper communication, proper understanding of it, and that information that you get when it's right, then you can plan appropriately.
Yeah, and I think it's important. I mean, as you mentioned, Matt, how would you get the money, or how would it be taxed? So the way that the CARES Act states is that you can spread the income over 3 years, you can pay it back over 3 years, or because your income maybe has dropped this year, you may want to take all of it this year and show it on your taxes. It certainly could be better for you. The 401k loans, as you mentioned, it went from a $50,000 maximum up to $100,000, and not really needing to pay on that loan until next year. So that's an option. Bill, you mentioned home equity loans. So that could be another option. With interest rates as low as they are right now, maybe you already have a line of credit on your home, and you could utilize that. And what I've seen in cases is that folks do have reserves. They have money that they can get to, and they like keeping that reserves, which it's a good idea in kind of normal course as you move along, to have a reserves for those emergencies, those things that come up that you absolutely need it. But use the reserves, or use some of it at least, versus maybe taking it from one of your plans, your retirement plan, IRA, and so forth. And as we stated, you really want to make sure that that you understand it from a tax perspective, and how it's going to affect you, because oftentimes you could put yourself into another bracket, and it really affect you from a tax situation. So taking Social Security early may or may not be the best situation. And I did want to mention that, in the last segment we talked about, and it may have seemed as though we're encouraging not to take Social Security early, and that's really not the case. Oftentimes we do have spouses that one takes it early and one delays it. So there's just so many options that you really need a knowledgeable advisor on how to bring everything together. So Matt and Bill, I want to thank you for joining me today. In this trying economic time with our show, we want to bring you updated information. We want to talk about the economy, how we see it, and give you some highlights, as well as we want to work in other financial strategies. And we're doing that in a way that we hope brings you valuable information. We do want to mention that we're working on some other topics for the future, things like college savings, retirement travel. Travel will be back someday. Reverse mortgages, estate planning, investment planning, more Social Security options. There's a lot of other show topics that you'll see upcoming. So as a small business owner, I realize this is a tough time. This is a tough time for everybody. We don't know the health situation of our economy. The economy is shut down, and people are getting a little stir crazy. This will change. It will get better over time. We just have to be patient, and we have to know that it will be positive. So thank you for joining me today, and until next time, for Matt Arends and Bill Davis, I'm Eric Brenner.